Hello everybody and welcome to another episode of Options Discovery on John Lothian News' The Spread. My name is Alex Tang and just like many of you, I am no expert in the world of options. But with the help from some, we can learn more about options together. In this week's episode, we're going to talk about how an option's value changes over time. We're also going to get to sit down with options mentor and longtime trader Dan Passarelli. Dan is not only a trader, but he's also an author and the lead mentor and founder at Market Taker Mentoring. So you're really going to want to stay tuned for that interview. Before we talk about how an option's value changes over time, we first need to look at what gives an option value in the first place. And an important concept to note here is the difference between an option's intrinsic and extrinsic value. Both these values, intrinsic and extrinsic, are reflected in an option's price, otherwise known as its premium. So let's start off by talking about the intrinsic value of an option. And that intrinsic value is essentially how much that option is in the money. See, out of the money options have an intrinsic value of 0. Now, an option starts to gain intrinsic value, like I said, when it becomes in the money. So for calls, this means that a call starts to gain intrinsic value when the underlying price exceeds the strike price. And for puts, this is when the underlying price gets lower than the strike price. Now, the intrinsic value can be calculated as the absolute value of the difference between the strike price and the underlying price for in-the-money options. All right, so the next topic we're going to talk about is the extrinsic value of an option. Now, an option's extrinsic value is a little bit more complicated than its intrinsic value because it's determined by a variety of factors. This includes things like the volatility of the option, the time until expiration for the option, the strike price of the option, and even the price of the underlying, just to name a few. After watching this video, I suggest you go back and watch the episode 11 of Options Discovery, as in that episode, we go over the options Greeks, which really tie in heavily with what we're going to talk about today in extrinsic value. See, as an option gets closer and closer to expiration, the extrinsic value of that option approaches 0. And at expiration, the extrinsic value of all options is 0. This means that when an option hits expiration, it is essentially worthless. The erosion of extrinsic value over time is referred to as the Greek letter theta. So theta is often also called time decay and represents the change in an option's price over the passage of time. And this is often represented as a daily rate. A good way to visualize the effect of theta on an option's price is through an example. So here's a quick example that I'll give you. Let's say that we have a call option with a premium of $1 in 20 days until expiration. The theta of this option is negative 0.04. In our example, theta will be expressed as the loss in time value per day. With the passage of time of 1 day, this option will decrease 4 cents in value to 96 cents if all other factors remain the same. See, theta is often represented or expressed as a negative daily value to give you the idea that theta is the erosion of extrinsic value over time. The last thing to mention about theta is that it is not constant. This essentially means that just because theta is, let's say, negative 0.04 today, doesn't mean it's going to stay that way tomorrow or a week from now. In fact, the theoretical rate of decay usually tends to increase as the time to expiration decreases. This means that theta, or time decay of an option, will accelerate as you get closer to the expiration date of that option, which also in turn means that the extrinsic value will decrease faster as you start getting closer to an option's expiration, and this is especially true of out-of-the-money options. Today, we are lucky enough to have Dan Passarelli for this week's interview. Dan is a renowned options author as well as a former CBOE floor trader. Dan is also the lead educator at his firm Market Taker Mentoring, where he is also a contributor on many different other media sites like Bloomberg, Fox Business, and TheStreet.com. So we're very lucky to have him, and please enjoy my interview with Dan Passarelli. All right, everybody, welcome to another episode of Options Discovery. Today we have Dan Passarelli here, author, options mentor, former floor trader. Can you please introduce yourself and your background, how you got to where you are today?
Yeah, I'm Dan Passarelli, and thanks a lot, Alex, for having me. So I started out, I went to college in Chicago, incidentally, the same place that you went. And I was a finance major, actually. And I was just always interested in finance. I didn't really know what I was going to do with it. But during college, I would walk to the Chicago Board of Trade, Chicago Board of Options Exchange. And back then the visitors galleries were open to the public. And so I would actually go upstairs and I would just kind of watch, and it was always very fascinating to see the traders just doing what they were doing and trying to figure out what they were doing. And upon graduation, I thought, I want to go try this out. I didn't really realize that I could actually be a trader, but I just wanted to go check it out. And so I printed up some resumes, knocked on every door of the Chicago Board of Trade building, and got a job as a runner. And the rest is history, as they say.
We're super happy to have you on today. So our topic for this week is intrinsic and extrinsic value of options, which is a concept that is something that is very important for all options traders to really understand. So I'll just start off with the first question for you, which is just, can you explain the basic concept of what the intrinsic value of an option is and why it's important for options trading?
Sure. Yeah, it's really important. Intrinsic means like real, actual, like at the heart of it, right? And that's where we get that term, even when it comes to option trading. So imagine that I own a 55 strike call, which means it gives me the right to buy the stock at $55 a share on or before the expiration date. Now, if the stock is above there, that's good. I own the right to buy it at a place below where the stock is actually trading. So I could exercise those calls, buying the stock at 55, and then immediately turn around and sell it at 60, wherever the stock is, and lock in that $5 of profit. So that would be like a real sort of unarguable value. We can also call that the in the money value as well. But yeah, so that's one of the components of option pricing.
What would be the intrinsic value for an option that's out of the money for our viewers to know?
Right. So that would just simply be zero. So, same example, the stock is at 60, but I own the right to buy the stock at 65. Then I wouldn't exercise my right to buy it at 65 if I can already buy it at 60. There would be no intrinsic reason for that. There's no real like immediate arbitrage type value of that option.
Just taking the perspective of a retail trader, so I know now what intrinsic value is, but I'm looking at the options to trade, and I'm seeing that there are out of the money options that still have some value. They still cost money, they still cost a premium, and I guess that kind of leads us into the other type of value for an option, which is extrinsic value. Can you give us a brief introduction to what that is?
Yeah, so that is where options really get interesting, because I think a lot of people think of options as, simply a substitute for the stock. Hey, if I think the stock's going up, instead of buying the stock, I can buy the calls and I can get more leverage. But there's so much more to that. That right in and of itself has a value because it can potentially be worth something. And so, would I ever, if you think about it, if the stock's at 60, would I ever consider buying the right to buy the stock at 65? First, to a layperson, it might not make any sense. Like, no, why would I do that? But if I can pay just a little bit for that, and if the stock, for example, is fairly volatile, or if there's a real lot of time until expiration, that call can be worth an immense amount of money, right? Like if the stock goes to 100 or something over the next year, right? So like it's that right that we're trading. And that's where the extrinsic value, the value outside of just the very simple, here's where the stock is, here's where the call is. And that brings into like a lot of other pricing factors besides just the stock versus the strike price.
Yeah, that's really interesting. And it seems like extrinsic value is not determined by just one factor, but by a variety of different factors. Can you kind of go into the different components that really decide that extrinsic value of option?
Sure. For many, many years, I would say there are three main factors, but now there's four. So I'll finish up with the new old one, or old new one. I'm not sure which way that goes. So I guess back to the same example here. The stock's at 60, buying the right to buy it at 65. Okay, it only has to move $5. There's a couple considerations there. First of all, how volatile is the stock, right? If the stock barely moves, it hasn't seen $65 or $55 in 3 years, it's a boring stock. Probably wouldn't want to buy that call. It probably will never have intrinsic value. So, but if the stock is very, very volatile, it was 100 yesterday and 50 the day before, it has a much better chance of having some value. So the amount of volatility in a stock will affect the value of that right. The amount of time that I have that right for is valuable too. If it's expiration day and the end of the day is going to be in 5 minutes, that right might not have a lot of value if we're still $5 away from it. But if the call doesn't expire for a year, well, then it's much, much, much more likely that the stock can move up from 60 to 65. So there's more value the more time there is. Also, if the stock's at 60 and we're talking about the 200 strike call, man, the stock has to move a lot more. It's so much less likely that the stock can get up to 200. And so because of that, I guess we talked about three things now, right? Volatility, time, and the stock's price relative to the strike price, how close it is, which we might call moneyness. And for many, many years, we were in basically a zero interest rate environment, but now we're not. And the interest rate also affects the value of options, because if you think about it, if I could buy a call as a proxy for buying the stock, right? 100 shares of a $60 stock would be what, $6,000, I guess, right? But maybe I could buy the call for $2, just $200. Well, I could leave the rest of that money, the $5,800 in the bank, and earn interest on it. So that affects the value of the call in and of itself, right? Because the call ends up having a little bit more value the higher interest rates are. And I'm using calls in all of our examples here. We can make the same case for puts in all of these different examples, but just sort of keeping it simple.
What tools or what models do traders use to measure these and use it for more practical applications when it comes to trading?
Yeah, I mean, to me, the most important thing, well, one of the most important things that a trader can use, like the best tools in the toolbox, are what we call the option Greeks. And the option Greeks measure the effect on option prices of how much the stock price moves relative to the strike, time passing, the amount of volatility, and even the effect of changes in the interest rate. Because it's very important to understand how each of these affects the option, because if you think about it, when you're trading an option, any option, even something as simple as buying a call or something very complicated with multi-legs, you're always really trading all four of these things. You're trading, there's always a directional component where you'll make or lose money, a time component, a volatility component, and an interest rate component, whether you want them or not. So the more access to that information, the more you look at the Greeks, the more control you have over your own positions. The more you can understand them, the more you can craft better ones, the more you can plan better exits and even entries.
Can you explain a little bit more about when people talk about options as a decaying asset? What does that mean, and how is that measured?
Yeah, so as time passes, options become worth less. It's sort of the same logic, but just in reverse of what I was talking about before. The more time there is, intuitively, the more value the option has, because they have the potential of being worth more. So as time passes, there's less time, for something to happen, so there's less value. And so traders who trade options in whatever capacity, like, really need to understand how fast that those options become worth less, how fast that time decay happens. And we measure that with the Greek theta. All right. So theta, if I'm an option buyer, right, I'm the person who's buying that call because I think the stock's going up. Well, I know if the call is going to lose 25 cents of option premium a day, it's got to go up enough, as measured by delta, in order for me to make on average 25 cents of premium a day. Like, really, really important stuff here. It guides my entire strategy selection. And some people will choose to capitalize on selling options because they decay, and they're putting that little extra factor in their advantage. And, they want to see if it's worth it. Do I make enough in a 1-day period, or is my profit so low relative to the risk that it's not worth it? And another thing to consider here too is, if you think about it, it'll be intuitive after I say it, but it might not be yet. The intrinsic value, that's simple, straightforward math. It's the in the money value, stock price minus strike price. So there is no time decay on that, because as time passes, intuitively, in hindsight,
Yeah.
right? In hindsight, that wouldn't be worth less as time passes. So it's only the time value part of it. And that really kind of helps us kind of separate things in our minds better, and sort of, craft better strategies, like I said, and think about what I'm trading in which component of it.
Yeah, that's really interesting. And it's something that is really important to understand how these different factors kind of come into play. One thing that I guess would be my question would be, obviously you have this time value that's decaying. How do you separate that from other things that could be increasing? Let's say volatility starts to increase, so you see that intrinsic value start to rise, but at the same time, that time decay is a factor. How do you isolate those different factors in extrinsic value?
Yeah, I mean, if you just sort of start thinking about it from a lay perspective, it can just be mind blowing. Like, oh my goodness, how do I keep up with all this stuff, right? But it all sort of ends up coming out in the end. Like, the option premium changes. A lot of newer option traders, like, they won't look at the Greeks. They'll just look at how the option premium changes, and they'll have all these questions. It's like this mystery. Like I bought these calls and the stock went up, but my call is down and I just don't understand. So breaking them down and looking at those components is a game changer. So knowing that, there are these 4 main factors, but truth be told, rho, or the effective interest, is still a very small factor, even now. So we really only need to focus on and think about delta, which is the stock moving, theta, which I just talked about, measures the time decay, and then vega, which measures volatility, which is probably a little bit of a longer discussion. But whenever I'm making a trade in what we call the option chain on my retail trading platform, I have columns for each of those. I have a column for delta, I have a column for theta, and I have a column for vega. And so when I'm doing my forecasting, if it's a directional trade, I'll look and I'll say, okay, well, how far do I think that this might go? Okay, well, that means my delta would give me this much profit. How long do I think that move will take? Because that matters a lot, right? I think it'll take 2 weeks. Well, then those calls will lose value by that amount. How much do I think volatility will change? I'll factor that in. And so, I mean, it can feel a little bit intimidating at first to watch these 3 things, but it's only 3 things. You sort of get in the habit of it, and you look at them and think of every single option trade as kind of like trading a basket. You're trading these 3 different things, and boy, I guess that's probably a lot easier than an arbitrage. We're trading, 500 stocks against the S&P 500. They've got a lot more things to think about than 3.
I also wanted to talk a little bit about just the different paths that you recommend for a beginner to start learning about options. And I guess to kind of conclude that question, what are the programs that you recommend that people reach out to at Market Taker Mentoring as well, in terms of, if I'm a beginner and I want to learn about options and learn about all this trading stuff, what is the best path for me?
Um, it's funny. Just yesterday, I was talking with Bobby, who's on our marketing team over here, and we're going to be doing stuff on radio. Basically, I'll save the long story. And we were thinking, well, we could do this and we could try that. And I was like, hold on a second, wait, stop. This is the exact thing that I talk about with our student traders. There's also already someone who has done this before and knows how to do this. We don't have to reinvent the wheel. Let's find that person and ask him. And if there's a course out there, we'll take the course. If it's $500, $1,000, 5,000 to get that information so that I don't have to make all those costly mistakes financially, time-wise, and have something that should take a week take 6 months. I'd so rather do that. And that's hard for a lot of people to wrap their head around until you end up either getting into the education from the teaching side of it or just taking enough education. And I am on both sides of that. Just this idea of somebody else already knows how to do this. Why would I try and figure it out and piece together these puzzles with a blindfold on instead of just have somebody tell me how to do it? So yeah, I'm a big fan of that. Not because I'm in education, but I'm in education because I'm a big fan of that.
Dan, I really appreciate you coming on the show. Where's other places people can find you? I know, I've kind of seen you all over the options internet, but where's a couple places where people can find your work?
Yeah, Alex, if your folks want to find me directly, you can make your way on over to markettaker.com. That's market as in stock market, taker as in take what is rightfully yours, 2 T's in a row, markettaker.com. And you can actually go to the top right of the screen and click join free, and you can join our community free. We have, especially for new folks, we've got some great classes and resources there for a limited period of time. You can actually join our chat room and participate in the community there and get some great trade ideas. So yeah, we'd love to have you and help any way we can.
All right. Well, I appreciate it, Dan. Thanks for coming on the show, and hopefully we can speak to you in the future.
All right. Thanks for having me, Alex. Talk to you.
If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.